If you've been looking at this public markets lately, you've probably noticed that a lot of tech companies are down significantly over 2021 numbers. And that's largely driven by companies, SaaS businesses, enterprise SaaS businesses that have seen a massive drop in the valuation of their companies. So in today's video, I'm going to talk about how SaaS businesses are valued, generally speaking, what happened, why valuations were super high in 2021, what was driving that, why they're super low now, and the way I'm thinking about SaaS investing in today's market. All right, so the first thing is we got to understand how SaaS businesses, enterprise SaaS businesses, are valued. Now, SaaS stands for software as a service, and the idea here is that you have your software, you provide for customers, and they pay you on a monthly or annual basis for access to that software. And the benefit is that instead of having different releases, they just, you're constantly improving the product. They're getting the constant benefit of that improvement. You get really good visibility into future cash flows. They get kind of the latest, greatest, best product on an ongoing basis with the support they need, rather than, every few years having to re-up and fork out more money. They also have a better idea of how to budget for their software expenses going forward, right? They just know every year it's going to cost X, right? Or this much per seat or whatever it might be. So a lot of advantages for SaaS businesses, and there's a lot of reasons why investors really love investing in SaaS businesses. Now, SaaS really took off, if you back up, really took off back in the early 2000s. And, you had this huge shift in the market led by companies like Omniture and Salesforce and others that basically said, this old model of buying software, installing it on your own servers, your own computers in your business, and then when the new version came out, going out and buying that new version and, getting rid of the old version and installing the new one, we're going to get rid of all of that. And what we're going to do is we're going to leverage the internet. And by leveraging the internet, we're going to give access to businesses and customers to come use our product whenever they want through the internet, and then they'll just pay us for access to that every month or every year, right? And that thereby led to the birth of SaaS businesses. And I remember when I first got into the industry, this was back in 2007, there was still a lot of debate about how do you value a SaaS business? And people didn't really know exactly how to do it because it was so different, right? What matters? Is it bookings? Is it contracts? Is it recurring revenue? How do you figure that out? And over the last 15 years, there have been a whole bunch of different metrics to help investors figure out how to evaluate a business, and also for operators to know whether or not they're doing a good job and where they should be allocating more time and energy and resources. That said, most SaaS businesses today get valued on really just a handful of things that are kind of equivalent to a lot of other businesses out there. The first one is they get valued relative to their annual recurring revenue. So oftentimes you'll see EV to revenue or EV to ARR. EV is enterprise value, and that simply is if I want to go and buy the entire company, I want to buy all the assets, right? What is that number? And so if I'm going to buy all the assets, if you think about the basic accounting equation, is assets equal to equity plus liabilities, right? It's basically all the stuff you own and how you bought it. Did you borrow money or did you use your own money, your own equity to buy it, right? And so if I want to go and I want to buy the whole company, I got to buy all the assets, which basically means I got to buy all of the equity and I got to pay off all the debt, right? And so enterprise value is simply simply equity plus liabilities minus the cash. And the reason for that is because you're not going to buy cash with cash. It just doesn't make sense, right? The cash that's on the balance sheet, you take it out and you say, okay, that's not part of the overall acquisition price. So that's how you get EV. And so when investors are looking at companies, they're saying, okay, what is the total value of the company divided by the revenue, or in the case of SaaS businesses, more likely the annual recurring revenue of that business, and that gives us some sort of multiple. So those multiples could be anything. They could be less than 1, they could be 100x, right? But let's say I'm paying 10 times EV to rev, then that means that the value of the company, all the equity, all of the liabilities, everything, I want to buy the whole thing, is worth 10 times what they're generating in revenue today. That's what that number would infer. If it's 3, then I'm paying $3 for every dollar that company is generating in revenue or recurring revenue. So that is the general metric that's used. We use that multiple because it allows us to compare different businesses at different sizes. Like, how do you know that a company that's doing $1 billion in revenue is overvalued and a company that's doing $100 million in value is undervalued? Well, you can use multiples to kind of take out the differences in what they're doing in terms of actual revenue and just say, okay, how are these two companies actually being valued on a multiple basis, right? That company that's generating $1 billion in revenue could be valued at like 15 times their revenue, and another company could be valued at like 3 times their revenue. And if they're both growing the same and everything else looks the same, then you would maybe say, well, hey, the one that's being valued at 3x revenue is undervalued. That's where I want to put my money and invest. So that's the value of these multiples and how they work. Now, there are other things that factor into that. And so you'll see differences in value in these multiples depending on a bunch of different factors. So the ones that tend to matter the most are the growth rate of the business. How fast is it growing? All things being equal, a company that's growing faster is going to be more highly valued, right? Because the idea is that over time, this company will get bigger and bigger and bigger and become more and more and more valuable. The next one is churn rate. So how often are customers leaving the platform? If a company has really, really sticky customers, it's going to be valued much higher than a company that loses customers very frequently. And that could be like churn due to companies that decide like, hey, this product's not for us, but it also could be like companies that just go out of business, right? It's not even your fault. But if you've got a lot of customers that go out of business, that's usually not a good sign for your business, right? So churn rate matters a lot in terms of determining the value of a company. A company with a low churn rate is going to have a higher valuation because those customers are going to stick around longer. They're going to have higher lifetime values, all things being equal, and thereby generate more returns over time. Another really big factor is market size. So if you operate in a market that's really, really big, right, you're going to have a much larger opportunity to grow and become really, really big. And so investors may be willing to invest at a higher valuation in your company with the belief that over time you'll get bigger and bigger and bigger. Now, the other factor I want to touch on that really drives valuations, and you've seen this a lot lately, is investor demand versus alternatives. So if you've got lots of alternatives as an investor, then you may not be willing to pay as much for one company versus another because, hey, I've got all of these other things that I could invest in instead of your company, right? On the other hand, if there are relatively few options relative to the amount of money you have, then you would see those valuations rise. And this is exactly what's happened over the last few years, is that there's been lots and lots of money plowed into the hands of investors, and those investors have had a limited number of companies that they could invest in, and that has pushed valuations higher. Now, there are a whole bunch of other metrics that also matter. I cover some of them in some of my other videos, so be sure to check those out. But in general, like growth rate, churn, market size, and then overall like demand from investors are the things that, in my opinion, are really driving a lot of the valuations in these companies. So let's talk about how valuations have trended over time, particularly in the public markets, and how that impacts private markets. If we look at SaaS valuations of publicly traded companies since 2015, the long-term average from 2015 to 2019 was roughly anywhere between 5 and 10x revenue. So if a company was generating, $100 million in revenue, they would be valued anywhere between $500 million and $1 billion. And that was pretty standard across most companies. And then what you saw is it was this gradual, it was pretty flat for 2015 to 2018. And then 2019, it starts to grow and climb. And at its peak between 2019 and 2022, with a special emphasis on 2021, valuations went from being 5 to 10x to being 10 to 35x, and in some cases even higher. But if you look at the major ranges, it really was in that 10 to 35x range. And so, all-time high valuations in SaaS, but really only for a short amount of time, only a few years. And today, valuations have come right back down to that 5 to 10x range, which is really where they've been over the long run. And so a lot of people look at these companies, they're like, oh, the market's down and we just got to wait till it recovers and it'll come right back up to those 2020 2021 numbers. And the reality is it's probably not going to happen. And the reason for that is severalfold. So one, you got to understand like why we got into that situation when we did. And the way to look at that is to look at how much money was available in the broader economy. So if you look at the Fed's data for M1 money supply. Now, M1 money supply is like the most liquid money that's in the market. That's like your cash in your pocket, you have money in your bank account, right? Like the money that you have access to, not money invested in stocks and other things. That's like a whole other thing. But if you just look at like cash on hand, essentially, right? In the 90s, for most of the 90s, it hovered at or just above about $1 trillion. And then it started to pick up. Through the early 2000s, and then we had our first major recession. The Fed came in and said, okay, we want to help get the economy, humming again. We're going to start pumping money into the money supply. And you saw money go from, 1 trillion to like 1.75 trillion by 2010. So from 2010 to 2019, you had a pretty steady and aggressive growth in the money supply. It went from 1 trillion to $4 trillion. That is a huge increase. I mean, you think about like the 90s, it took like 20 years to go from 1 to 1.75. And then it took 10 years to go from 1 to 4, right? So like, huge increases in the amount of money that's out there. The flip side is we had, tons of technological advancement. We had like global economies and globalization occur. And so you had a lot of things where like this money could go to lots of different places, right? But then the pandemic hits. COVID hits, and the federal government and the Fed start pumping in money really aggressively. And so you see the money supply go within like a couple years, go from 4 trillion to $7 trillion. That is unheard of like growth in the money supply. Well, all that money needs to go somewhere, right? Now, a lot of it went out as like stimulus checks. People took that, they went and they bought stuff with it. That money flowed to managers of capital, i.e. investors, and they needed to put that money to work somewhere, right? They wanted to generate returns on that cash. So what did they start doing? Well, they looked at all of the different things that they could invest in, and they realized that, hey, you've got all these tech companies that are generating record returns. And so that is where we're going to invest, because over the last 10 years, we've seen tons of these companies that have gone on to be really successful, Airbnb and Spotify and Snapchat and Uber and so on and so forth, let alone like the big companies like Facebook and Microsoft and Google. And so all these investors start shoving money into the tech sector, but there's only a relatively small number of technology companies out there relative to how much money is available. It's not like technology companies doubled in 2 years. The number of technology companies doubled in 2 years, just like the available cash did. And so that led to basically a bubble in valuations. It doesn't mean that these companies are bad companies, but there were just so many investors chasing after so few deals. And that drove valuations from that like 5 to 10x range to the 5 to 35x range. The problem is that everybody knew that wasn't ultimately going to be sustainable. And what happened is not just in the tech sector, but in every other sector of your life, right? You probably saw groceries go up, rent goes up, like gas goes up, like everything was going up. And that resulted in inflation. And the Federal Reserve has come in and basically said, okay, in order to fight inflation, we got to pull money out of the money supply. And so now we're watching the money supply like take a dive, right? As the Fed tries to fight inflation. What that's meant is that all of a sudden there are investors that don't have as much money. And actually more impactful is a lot of the investors still have the money that they got back in the 2021 years. They're worried, and rightfully so, about where's the money going to come from to continue to support my investments in the next few years. And that is the big challenge. It's in venture investing and in all investing, you don't want to be the last person holding the bag. And so one of the challenges is that if I'm going to invest in this company, who's going to write the next check into that company? And so a lot of investors, even if they have the cash, have really pulled back and said, hey, I'm going to be super picky about which companies I back. I'm going to back the ones I've already invested in to make sure that they ultimately are successful because I've got money tied up there. And then I'm going to be really picky about where else I invest. And what that's done is that's all pushed downward pressure on valuations. back down to the 5 to 10x range. And so sometimes I get a lot of questions of like, hey, when is the market going to recover? When are valuations to come back up to where they were? And my response is like, I think valuations have come back down to where they need to be over the long run, probably in that 5 to 10x range. What does that mean for private investors and venture capitalists like myself? Well, if I'm forecasting where my company can exit based on where I'm investing today, then I need to understand that like valuations really are going to be in that 5 to 10x range, and that's really where I need to be investing. Hopefully this video was helpful in terms of understanding how SaaS companies get valued, where valuations have been, and where they're going. Let me know what you think down in the comments. Be sure to like and subscribe, and also check out some of my other videos like how do private equity funds find companies to invest in and buy. Thanks.